Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. So once again, there seems to be one major immediate feature in this market and one other possible feature that may develop. The major immediate feature is what is now the late September to date dark blue bear channel, currently 2038 to 2242. This developed from what was originally a descending wedge pattern, morphing into a larger bear channel. Prices last week played around and eventually moved below a small congestion band between 2140 to 2148, made up of the 50% Fibonacci line of the March 21 to October 23 move and the November 2017 high, respectively. The next congestion below is the 2084 to 2069 band, with below that congestion at 2047, which currently has wrapped around it the flatlining mauve medium moving average, currently 2053, and the gold long moving average, currently at 2041. And just below that is the dark blue lower bear channel. Over all of this is a congestion band from January to February 2017 between 2010 to 21 even. Now these congestion bands, moving averages and lower bear channel will be tougher to deal with than that earlier one. So now to the possibilities, and that is to look at the whole early September today action as either a topping action with potential down to the 19 cents zone, or as a potential bullish half hesitation with potential up as high as possibly 26 cents. This is a big picture item, and as I've already mentioned, it is all just a possibility right now and would require further study of the market actions. But I do wish to make sure that you're aware of these possibilities rather than get surprised by them at the last moment. Until that happens, the dark blue bear channel is the ruling pattern on this market. Ice Europe white sugar in London. From the lopsided island top formed over late September, this market has been gradually moving sideways to a little lower, and in the process getting itself trapped between three moving averages until 3 weeks ago, when it looked like it was escaping before once again getting itself trapped again in amongst the moving averages. So on the top side is the gold long moving average, currently at 567, that has been assisted at a distance by the dark blue upper trend line extension and downtrend, currently at 584.80, of the January to September this year descending triangle, as well as in the past by the 50% Fibonacci line, the July 21 to November 23 move at 592.80. As for support, we had seen this sort of from the green short medium moving average, currently at 565.5, but this has proved to be a mirage, and this moving average has been acting more as a nuisance than as a support, but it seems to be allying now with the resistance of the gold long moving average right now, though I have my doubts about it as still being no more than a nuisance. So that details what is topside. Now looking below, we have the flatlining mauve medium moving average, currently 549.30, along with the March 2017 high at 548.70 and a lesser Fibonacci line at 550.20. These three all worked together until 3 weeks ago when prices sallied lower, but were quickly turned back by a bullish hammer pattern 3 Wednesdays ago, and with a changeover as well. So we've ended up back within the nest of the moving averages, but we are not fully there, with the slowly declining gold long moving average overhead, and today the mauve medium moving average, previously breached, being breached again last week, but also only with solitary closes below it, and the market seeming unable to stabilize below, though I personally suggest that support breach now a few times, including today, may not be as strong as seen before November's fall. Nevertheless, I think the overall picture is the same as I said 3 weeks ago, and I quote, "In the meantime, until we break one or another, the market seems capped by the gold long moving average overhead and supported by the mauve medium moving average below." Remember, one close even doesn't make a move or a break, and if you look at 3 weeks ago, those multiple closes didn't even make a break. Sugar white premium spread. Now, 31 weeks ago, the market made a huge combined weekly reversal down and bearish engulfing pattern. I suspect this was in large part due to London Sugar Month changeovers, but it nevertheless was the seminal moment and set in motion a lower market, though prices took their own sweet time in getting down there, hesitating between mid-July to mid-September, then testing the lows of early to mid-October last year down to the 115 and 3/4 and 116 even zone. 12 weeks ago, I highlighted a significant weekly pattern, an immediate countering key reversal down and bearish engulfing pattern, which led to prices punching down through the 115 and 3/4 to 116 zone, and then down through the next congestion zone below, made up of the lesser Fibonacci lines at 107 3/4 and 104 1/2. I spoke 11 weeks ago about supports below, and I quote, "The next support of note would be the lows of the first week of February 2023 at 83 even, the mid-February low at 83 and 3/4, and the early February low at 81 and 3/4, end of quote. I continued further, and is an important piece I dealt with, and I quote, "The only other feature to consider is a new one I have drawn on my weekly charts, which is not as yet established but which deserves consideration. It is the April to date descending wedge pattern, currently 73 even to 101. This is still a nascent pattern, but one worth watching," end of quote. 11 weeks ago, prices breached and closed below this pattern, and it was no longer a nascent pattern, but the main one. I added the following, and I quote, "The key feature to watch for, apart from the obvious breakout of the descending wedge pattern itself, is when the lower trend line crosses the purple neckline extension to the significant February to September 2020 head and shoulders top, currently at 77 even. This will be approximately during the week ending the 22nd of November this year," end of quote. Well, we had that week 2 weeks ago, right after a big attempt lower 3 weeks ago, formed of an immediate countering weekly key reversal down and bearish engulfing pattern, and prices broke down through the purple neckline, and also the November 2021 low at 68 even, reaching the primary target on the downside, but then halting there and staging a partial recovery. Though I do note how the previous support detailed earlier around, and I quote, "the lows of the first week of February 2023 at 83 even, the mid-February low at 83 and 3/4, and the early February low at 81 and 3/4, end of quote, how these all seemingly capped the market. So the primary target has been reached, but before I detail the secondary target, I'd like to discuss the reactionary move back up over the purple neckline and the dark blue lower trend line, also the green short medium moving average, which is currently at 77 1/4. I said 2 weeks ago, and I quote, "I am not convinced of the pressure behind this bullish move, but as I said last week," so that is now 3 weeks ago, and I quote, "it is very, very precarious, especially today," end of quote. I will now be watching carefully the action between 85 even overhead and the purple neckline below, so that what we have in the way of opportunities and barriers on the downside and top side I'll now detail. I'll try and keep it simple and short, as the much larger picture has even me somewhat scared. So below the dark blue lower trend line, we still have the November 2021 low at 68 even, and then the congestion zone between 55 even down to 45 even, dating from July to September 2021. In the bigger picture, well, I'd previously looked for opportunities presented by the break below the descending wedge pattern. The primary target, as I said earlier, had been reached. However, the secondary, much harder to reach target X1, well, that is quite a long way lower. Down in the 1 zone. Yes, 1 even. And this has gotten me somewhat scared, as this is below what I know to be the prior lows here, notably my 2009 low at 22 1/4. All this is without even considering the implications. Just possibly, the move lower may have triggered targets, finally, for the huge 2022 to 2023 diamond top pattern. And on that, well, I just shudder at the thought of that one. Meanwhile, top side, well, we have the Fibonacci congestion at 104 1/2 and 107 3/4, but we also have a changeover gap from September this year between 109 1/4 down to 100 even, par even. And though it is a changeover gap, it still deserves consideration. Should prices try this high, just be aware that up there we also have the upper downtrend nearby of the dark blue descending wedge pattern. That's currently at 101, and its seeming constant companion, the medium moving average, currently at 103 3/4.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.